Hello and welcome to the Accendo Traders Group. This is our weekend wrap-up trading plan for January 16th, 2010. Our website is blog.accendotraders.com, where we put together effective video technical knowledge trading plans on a daily basis. Yes, we believe that trading plans keep you focused and disciplined and abreast of what's coming down the market that can affect your open positions and as you're scanning for new trades. But more importantly, because you're disciplined, it cuts down on your research time so you can spend time with your family. The week that was, well, all the markets ended down fractionally for the week, still up for the year. Get more detail about that when we look at the charts. But overall, we had mixed trading early in the week. We had a Friday sell-off, and so the market ended up changed. We'll look at the internals and see if we see anything there. But overall, we had a good week for a dollar. We know a strong dollar hurts the market, especially on Friday. We saw that correlation. Also, we had fourth quarter earnings kick off this week, which started off with Alcoa missing on their numbers on Tuesday. Then after the close on Thursday, we had Intel beat. Now, here's a good thing about understanding how to trade, because we had the Thursday after the bell good Intel numbers, but then on Friday we had the bad numbers from JP Morgan Chase. They missed on their numbers. They only had 25 billion versus 26 billion. So that is what basically caused our sell-off on Friday. So what's going to be our driver next week? Well, you can see we don't really have a lot on the economic calendar. So what it'll probably be is the result of some of the earnings that we have for next week. So when we go into next week, you can see what? Banks. So with our economic data not moving the market, I really wouldn't be so much concerned with that. But you can see right off the back on Tuesday, we got Citigroup. We do have IBM after the close on Tuesday. But when you look at the week, we've got Bank of America, Morgan Stanley, Wells Fargo, Goldman Sachs, PNC, SunTrust, BB&T. GE has, their financial side, so we have a lot of bank, and so as we've been looking for it, the traders have been gone. We've been looking for a catalyst, and earnings season is in. Oh, and dare I forget to mention Google. So we're going to start off and take a look at our market here on a long-term weekly chart. We're looking at the YM, and we can see a great uptrend, of course, from the March lows. But we're starting to see a leveling off of the uptrend, and the candles getting smaller. So that does obviously have to give us a little concern. And also, you can kind of see on the weekly chart, we're a little bit above the huge push down. On the monthly chart's a little bit different. That's what we're going to use for our next target. But overall, certainly we don't have anything to complain about. We don't have any huge glaring sell signals, but we do need to concern about the leveling off of the candles. And we do need to be concerned about the candles getting smaller. Let's switch over to the ES. And we are going to get a similar picture. Actually, ES gave us a couple sell signals that the Dow did not. As we switch over to the daily charts, we want to take a quick look at the internals. And we can see that the volume has returned back in the market, although we had a couple light days. But the light days were the up days. Notice that the volume went down on the 2 light days of this week, but the volume increased on our 2 down days. So that certainly has to be concerning. And our 2 down days were very bearish. Look at our breadth. Below 0.5 is negative, and you can see we're very, very negative breadth on our 2 down days. However, our bullish days weren't really exactly, they're bullish, but 0.5, 0.6, not exactly glaring bullish days. This number was okay, but again, on lighter volume. So internal-wise, we're showing that the more traders took action, participated on the down days than the up day. Now let's bring up the daily view of the YM and the ES, and a couple things we'll see here. Again, a nice bounce off the 50-moving average, and then remember what we've been talking about for several months, and that was the 10,500 level. We started talking about it here with all these wicks, and we kept breaking. We said put your alert there, and then finally, basically, beginning of this year, we broke above that 10,500 level with some conviction. All good, yeah, woohoo. But what happened yesterday? we came down, and not only did we bounce off that 10,500, but we also bounced off the 20 moving average. So my standpoint is this: as I said earlier, if you're going to err to the upside. We've been in a great uptrend since March. If you're going to make a mistake, if you're going to make a trade, you should be leaning more bullish until bearish until the market says otherwise. So what I would be doing is thinking about putting an alert around 10,600 to go bullish, and about below 10,500, below this 20 moving average, to go to the downside. We can see we got a soap cell on the daily chart that's starting to kick in now. Our ADX negatives angling up. We just need the trend indicator to get a bit higher to show that there's a real trend behind it. But we really need to again get confirmation from the earnings. Is JP Morgan going to carry over this week? We'll find out, because we got Citigroup right there on Tuesday. Switching to the ES. And we're going to get a similar story. Here we were talking about a breakup about 1120. We got that. Very nice. And again, where do we come back to? 1120 and the 20 moving average. So the same thing. Below 1120, below the 20 moving average, and get up here around the 10 moving average, maybe 1140-ish, 1135 for the upside. Those were the futures, but as we look at the actual Dow Jones, we get the same thing here, except for we can see we're still above the downtrend line from the October levels. We did break a little bit the uptrend line from the March levels, and again the 20 moving average is acting as support. So again, that's why we want to use these levels as our breakout point. But look at the volume. You can see again the people participated on the down days, Friday and Tuesday. The NASDAQ shows us the breakout at the end of the last year, and that sort of choppiness again. We've seen this choppiness before, but where are we supporting at? The 20 moving average. So once again, the 20 moving average, the uptrend line from March, there's our point. So we want to put alert below that, and then of course you want to go above these highs, this week's highs, past week's highs, as a bullish confirmation. Following the S&P 500, and as I get repetitive, below the 20 moving average once again, and above the highs, I will put an alert for the bullish side. Now let's switch over to the monthly view to get where we may go. On the S&P 500, there we are, still sitting at the 50 moving average. So we really need to break that to really confirm that we're really going to go higher. Obviously this is strong resistance, strong resistance. For the NASDAQ, we're above the 50 moving average. We've taken out the push, and I would say the top of this push would be our target if we can continue this move upwards. But if we look at the 2300 range, which is where we bumped our head and came back, we need to get above that so that we can test the top of this push down. Finally, the Dow. The Dow is above the 50 moving average, which is good, and we were using this level here as our target if we were to continue to going higher. And that's kind of where, once again, we bumped our heads and came back. I do want to take a quick second and show you a couple of sectors that caught my eye. First of all, Dow Jones. We know Dow Jones is considered a leading indicator for as far as sectors. Dow Jones Transport, that is. And as long as we're above this level here, I'm okay. Stay above the 50-moving average. Also, look at consumer durables. Look at that. Look at that beautiful chart with a little pullback today. So that's certainly interesting. Aerospace also looks like a really good chart. But then we have some charts breaking down. Look at electronics breaking down, and also semiconductors breaking down. Semiconductors is also considered a leading indicator, and also some weakness in the gas sector. Finishing off with our education portion, Trading in a Zone by Mark Douglas, Chapter 11, Thinking Like a Trader. And the first stage, according to Mark, is the mechanical stage, where it's all about your system and developing the trust and confidence in your system and understanding that the probabilities of your system over time will win out versus the emotional trading, which wipes out your account. So the mechanical stage is about developing the right mindset for trading, which is psychological in nature, so that you can overcome the emotional trading that wipes out your account. Our partners, first we have a great futures trading room, 10-day trial for $30. Look at their track record and it speaks for itself. A futures broker, $300 e-mini margin, that speaks for itself. We won't find that. And great charting platform, no matter what type of trader you are, and a futures trading plan to jumpstart your trading. Remember guys, you can lose your money, so you need to learn about trading first. We got a great investment portfolio to look for on Kaching. Now that we can see your market gauge, we can start trading there. Follow us there on Facebook and on Twitter. Trade at your own risk, guys. I'll see you next time.